Hello, my name is Joe Hoyle and I'm a co-author of your financial accounting textbook. We're going to look here in this video at adjusting entries, and we're going to do this by looking at chapter 5 of your financial accounting textbook and focusing on problem number 3, because that problem gives us a good indication of how adjusting entries are done. Now, before I work chapter 5, problem 3, let's talk about the process so far. A company will have transactions. We know that. A transaction is something that is a financial impact. It has an effect on accounts. We take that account, we take that impact, and we use that to record journal entries. And the journal entries takes that impact, what went up and what went down, and it puts it into a journal entry in debit and credit form. So you debit one account and credit another account, or so on. That records the impact of the transaction. Then we go to the ledger. And in the ledger, you have all of your T accounts. So we might have, for example, a T account for cash and a T account for accounts payable, and so on. We take the impact of each journal entry and we record it in the ledger. The ledger has the account balances. The journal entry has the impact of a particular transaction. This process we refer to as posting. Now, whenever we get ready to make financial statements, we find the balance in each of the ledger accounts. We find the balance in each of the T accounts. We have to list that someplace. So we create a trial balance. And the trial balance is basically these balances listed in order, so that you can see what the account balances are so far with the company. If the company then is going to make financial statements, we want to check all of those accounts to make sure they're fairly presented. Therefore, at that point, we will often make what is referred to as adjusting entries. Now, an adjusting entry looks just like a journal entry. It has debits and it has credits, and they will balance. But a journal entry records a transaction. An adjusting entry records the impact of the passage of time. So if 1 month has passed, things will change. If 6 months have passed, things will change. The adjusting entry has to record that impact, the passage of time. After you make all of your journal entries and then your adjusting entries, then all of the accounts that you have should be fairly presented and you can make financial statements. So I want to look at chapter 5, problem 3, and we're going to start with question A and determine what has happened before and whether an adjusting entry is needed. In the first question, for example, the company has received $90,000 for work to be done. So I'm assuming that what happens is that they have already, this is a journal entry, they have already debited cash for $90,000 and they have credited unearned revenue for $90,000. Now, that unearned revenue account is a liability. And the reason the unearned revenue account is a liability is that you owe them the work. You owe them the service. If you don't do the work, you have to give the money back. So we look at that unearned revenue account as a liability. Now, do we have the passage of time? Yes. In this case, 1 month has passed. So has any of that money been earned? That's a tough question. This is probably the toughest part of this example here. If this is one big job, then it's only 1/3 complete, because 1 month out of 3 have passed. If it's one big job, then this is not substantially complete and you do nothing because none of the money has been earned. However, if you read the question carefully, it says that what really happens here is that there are 3 jobs. 1 job for the first month, 1 job for the second month, and 1 job for the third month. 3 independent jobs. In this case, the first of these jobs has now been done. The first month has passed. Therefore, because the first month has passed, 1/3 of the $90,000 has been earned, or $30,000 has been earned. It's been earned by the passage of time. So what we need now is we need an adjusting entry to record that impact. So what we will do is we will debit unearned revenue for $30,000, and we're taking it out of this unearned revenue account. It was $90,000 to begin with. It's been reduced by 1/3 or $30,000, and that money has now been earned, and so we'll record a revenue of $30,000. So if you had looked at this one before we started, if you made the adjusting entry to be an unearned revenue, debit $30,000, and revenue credit $30,000, that's perfect. That's exactly what you want. But if you missed it, make sure you see why you missed it, what entry they made to begin with, and what entry you need as your adjusting entry, so that the next time you see it, you'll get it right. That's really what education is about. That's what learning is about. Miss it the first time if you want, but make sure that the next time you're going to see it, you'll get it right. Now, let's look at question number 2, or question B. It says in this question that we have employees and they're paid every 2 weeks. They haven't been paid recently and they're owed $480,000 at the end of the year. There's no indication here that that $480,000 has been recorded. So when we get to the process of making our adjusting entries, that $480,000, as far as we can tell, has never been recorded. So we'll have to make an adjusting entry so that the financial statements will be correct. The salary expense has not been recorded, so we'll debit salary expense for $480,000. And we do owe that. We owe the employees that amount of money, so we'll balance this entry by crediting salary payable for $480,000. That will get your accounts correct. It will record the expense and the liability, so that when you make your financial statements, those accounts will be fairly presented. Why wasn't this recorded? Because it happens because of the passage of time. It could have been recorded, but this company chose not to do so. Question number C. It says that the company pays $300,000 for some rent at the beginning of the month, and 1 month out of 6 passes. So what happened? I'm going to change the way we approach this one. Let's look at the journal entry first. What did they do, as far as we can tell, when they paid the $300,000? They debited prepaid rent for $300,000, and they paid it with cash, so therefore we'll credit the cash for $300,000. Now, 1 month out of 6 has passed, so 1/6 of that $300,000 has now been used up. The future value has become a past value. So we take 1/6 of the $300,000, and 1/6 of the $300,000 is $50,000. And we take that out of the asset account and put it to an expense account. So we're going to make an adjusting entry, and we're going to debit rent expense, and we're doing this right before we make the financial statements. Debit rent expense for $50,000. That's 1/6 that has been used up, and credit prepaid rent for $50,000. Now that leaves in prepaid rent $250,000, and that amount represents the next 5 months. And it leaves in rent expense $50,000, and that amount records or represents the past 1 month. Remember, the expense is the past value, and the asset, in this case prepaid rent, is the future value. That brings us to D, our final question. And in D it says that we have agreed to do some work, and that work is going to cost $16,000. We're going to do that work. But so far, we have gotten, of this amount, 0. We've gotten nothing. And it says in the problem that we have earned nothing. We just haven't gotten to the work yet. We're going to do it, but we just haven't gotten to the work yet. So, in this question, we've gotten nothing, and we have earned nothing. Therefore, there's been no recording made, and there should not have been a recording made. Sometimes the accounts are correct. Therefore, because the accounts are correct here, you need no adjusting entry. You only need an adjusting entry when something has changed because of the passage of time. Now, I think this gives you a good beginning to look at adjusting entries. Always remember that what you're doing with adjusting entries is trying to make sure that you get the account balances updated. And why do the account balances need to be updated? The account balances need to be updated because, as we said, we have the passage of time. Always ask yourself, because I think this is the way to approach this, what has been done so far? What has the company recorded? And then, of course, what do they need to do to get the balances correct? Need to do for proper balances. That's adjusting entries. You can do adjusting entries. You can do these things, but it does take practice. Keep working. Make an A.